Frontier is an ASX listed company, which is developing the Waroona Renewable Energy Project in Western Australia. We've recently completed the Stage 1 DFS, which we're quickly moving towards FID over the next number of months.
Good to see it, and thanks for joining us. First time we might have spoken. So we're going to I'd like to do a kind of bottom-up analysis of where you're at, because you kind of got to where you are quite quickly, and I think it's time to talk about the economics of this thing as well. But first of all, when we kick off with you, what's your background? What have you done before?
Oh, yeah, 20 years in the energy and resources space, predominantly in the financial side of things. Spent a few years in London, but predominantly always in Perth. Yeah.
Okay, and so when you talk about you've been in the energy space from what position?
Yeah, so listen, I've been involved with Frontier since it came onto the ASX probably about 2.5 years ago. In between time, I was managing director at a company called Waroona Energy. So Waroona Energy was taken up by Frontier at the end of last year. When that was taken over, I became CEO of the company. Previous to that, I spent time at Lotus Resources. So Lotus is obviously a uranium development company that I think has been on here before as well. So across the uranium space and energy thematic in a lot of detail.
Right. Okay. So let's start with the business plan. What did you guys set out to do? What are you trying to build?
Right. So the company at the moment, as I mentioned before, we completed a definitive feasibility study in February of this year. That was looking at a solar battery project. So the Stage 1 project is 120 megawatt solar with an 80 megawatt 4-hour battery attached to that at the same time as well. So we completed the results of that. That was late February of this year.
Right, but it was okay. Just going back a bit, I'm really interested in the start and the genesis of this, because ideas change and evolve over time. Was that the plan day one? And if so, what fed that? What solution were you? What problem were you trying to solve?
Yeah, good question. So listen, the company actually listed on the ASX just over 2 years ago. So when it listed, it originally came on as a solar only company. Okay. After it listed as a solar company, I suppose the market started getting caught up in a little bit of the hydrogen hype at that point in time. The company looked around at what it actually had. To make hydrogen or green hydrogen, you need two things. You need green energy and you need water. The company had a lot of water around it. It's got a lot of infrastructure around it as well. We're close to 3 ports, gas connections, and electricity connections. So it was made for hydrogen. So the company worked through, did hydrogen studies. At the start of last year, the company did a global offtake search for hydrogen. Hell of a lot of interest from a lot of global names. The problem with hydrogen, in our opinion, at the moment is there's still really no price discovery for it. And if I give you hydrogen today, there's really still no consumption for it. So in the future, it's going to get there. We just didn't think it was going to get there today. So post looking at that, we still had the solar project, and we were looking at energy prices directly onto the grid. And you could see energy prices in Western Australia had increased by 80% over the last 2 years. At the same time as that, we started looking at batteries. So batteries, they've obviously been around for a number of years, but the technology has continued to evolve, which has also pushed down the price of batteries at the same time as well. There was another thing in Western Australia, it's a thing called reserve capacity. I'll go into it in a little bit more detail later on, but it's basically a payment from the state and AMO that gives you money to be energy available. They changed their technology, their base technology at the end of last year, from a gas peaking plant to a 4-hour lithium-ion battery. When they did that, it was a bit of the eureka moment. We got our skates on, completed the study, and this is where we're up to today.
Right. Okay. Western Australia, for those not aware, I guess it's the Texas of Australia. You kind of like to do things differently there. Talk to me about where the energy. You say you're talking about sort of a gas environment. Where's the energy coming from before, and why the switch to the lithium-ion battery storage?
Yeah. So listen, first off, so energy in Western Australia. So in Australia, first off, you've got 2 energy networks. Okay, so you've got the NEM. That's the whole east coast of Australia. So that stretches in far north Queensland out to South Australia. You've then got the other connection, which is the WEM, the West Australian grid. It's the largest microgrid in the world, but we're disconnected from the rest of Australia, okay? Forever and a day, the energy in this state, as much of the rest of Australia as well as the world, has been reliant on carbon emission fuel sources. So still today, coal is the backbone for energy in this state. It provides about 30% of energy today. The other backbone has been gas, okay? Obviously, the state has been coming through, as with the rest of Australia, where they're looking to decarbonise energy on the way through. So it was announced a couple of years ago that the state was going to start the retirement of their coal-fired generation plants. That is starting from next year moving forward. It's going to be fully retired in 2029. So you've got 30% of energy which is coming off the grid. At the same time as that energy is coming off the grid, there's a big increase in demand which is coming through. Obviously, everyone's electrifying everything at the moment. So there's a report in Australia done by AEMO. So AEMO is the energy regulator. They do a report every year called the ESO report, and that's the 10-year forecast into the future. The report came out 2 weeks ago, and they basically said over the next decade, demand is going to increase by about 55% in WA for energy. So you're taking 30% of energy away whilst you increase in demand by 55%. So there's a huge energy deficit on the horizon now.
Talk to me about, you said something a few minutes ago, we talked about, the increased costs of energy in Western Australia. Is that a legacy from COVID and supply chain issues? Because you're talking about, okay, coal was a big supplier in Australia, and there's also conversation around nuclear perhaps being a means of, replacing or substituting into that. Where's this? Is this 80% rise staying here? Has it found a new floor, or can we expect that to change?
Yeah, listen, as I mentioned before, so coal is about 30% of energy, with about 30 to 40, or about 40% of energy is still from gas. And I think gas is going to be required the whole way through in Australia, especially Western Australia, through the energy transition. Gas at the moment, when you look at domestic gas prices, it's about $8 a gigajoule. If you actually work that through in terms of megawatt energy, that's about $100 per megawatt, okay? So that is starting to provide a little bit of a new baseline for price, because the sun doesn't always shine, the wind doesn't always blow, as we know. So having that gas and coal coming through as that new baseline price, that's sort of where you're seeing it at the moment. So over the last quarter, the average price in this state was about $85 per megawatt, and it was quite similar the quarter before as well. It's actually interesting. In WA, excluding reserve capacity payments, which we'll go into, WA is now the most expensive place in Australia for energy as we speak.
Right. And obviously, I think you released an article which talks about power forecast generation deficits, which I guess matches what you're saying here now. Again, how will you insert yourself into that as part of a solution provider?
Yeah, so obviously stage one, as we talked about, it's 120 megawatts with an 80 megawatt battery attached to it. The idea is that in third quarter, we're just going through finalising financing at the moment. We'll have an update in that in July. Hopefully shortly thereafter, then we'll be going into an FID decision with first production coming on in the second half of 2026. But really, that is stage one only, okay? So taking a slight step back, with renewable energy or energy in general, if you don't have a connection on a grid, you've effectively got a farm, okay? You can't do much with it. The other thing that we have, which is crucially important to this company, we've got 2 connections onto the grid, on the largest part of the grid in the state. They're called ETACs, these connections. So the one ETAC we have is approved. The other ETAC is under application at the moment, which we'll start pushing harder in the new year. Each of those connections has a technical capacity of 550 megawatts each. So we combine the two, that's 1.1 gigawatts of long-term energy potential that we can put into the grid from our projects where we're located.
Right. Talk to me about the technology itself. I mean, presumably you don't manufacture these solar panels, so you've gone through a process of selecting a provider, and Western Australian government presumably has also had to do some diligence on, your technology solution, because looking behind you, as you said earlier, the wind doesn't blow and the sun doesn't shine necessarily every day. So how reliable a partner can you be with the technology that you've got?
Yeah, listen, it's a good point that when we've gone through this project, we've looked at other renewable energy projects around the world that have had delays. And what have been the reason why they've caused these delays? I think, being very generic, delays get caused if you're using something exotic or something new. It may be the best thing in the long term, but anything different is going to slow the process down. Everything we are using is tier 1 equipment that has been used on the grid before. So the panels, we're only using panels which have been installed in Western Australia already. The batteries, we're only using tier 1 batteries. You can guess who the battery manufacturers are. Only tier 1 batteries that we're using. Everything that we're using is as generic and as white, as vanilla as you can actually get. We want to make this as simplistic a process as possible with the lowest risk to get this project up and going as quickly as possible.
Right. Okay. So if I look at that, I guess my question would be, you've been quite honest about the numbers and so forth, and we'll get into the DFS, what the DF actually says in a second there. But like, just sticking with the technology for a little bit longer, how long do these solar panels last for? What is the kind of operating cost of maintaining them? And at some point, they probably need replacing. And I'll tell you why I ask, because there's been a sort of whole situation here in the UK where you've had water companies bought by private equity firms who've not invested into the infrastructure, and they've taken all the profits out. And where are we, some 15, 20 years later, we're asking the general public to pay for the billions of pounds replacement for the infrastructure. So for guys like you, it's going to be really important to set this up properly, be ethical about it, be honest about it, and have a plan for the long term, not just the kind of short term energy fix, which you're going to be able to get Western Australia.
Yeah, so I suppose first off, just in terms of the equipment selection, as I mentioned before, we've only used tier 1 equipment. On the solar panels as well, it's obviously been well documented. We've been quite fortunate when on a couple of metrics. So the first one is solar panel prices around the world. They are falling and continue to fall quite fast as well. At the same time as they've been falling, technology has continued to advance. A story on that, if I look at the last major industrial solar facility in WA, it was done about 2-3 years ago. There were 300 watt panels. The panels we're using are 615 watt panels. So even in a short amount of time, they've gone miles ahead. The other thing with the panels as well, we get a 30-year degradation warranty with the panels. So the panel manufacturer, they underwrite it for 30 years. When we get to the 30th year, they're still running at an 85% efficiency at that point in time. So it's not that year 30, that down to a low, this doesn't get turned off after 30 years. You continue on into the future. It's a very similar situation, to be honest, with batteries as well. So on the batteries, when we did the initial DFS, we went out to the 3 leading battery manufacturers in the world, and we got quoted up 80 megawatt 4-hour battery, so 320 megawatt hour battery. Again, battery prices were hitting the market at the right time. Battery prices for lithium-ion are falling dramatically around the world. There's a bit of an oversupply of them at the moment. 2 months after we got those DFS numbers, we went back to the preferred suppliers. They basically said, well, you can have a significant increase in the capital cost overall, or alternatively, you can now have a larger battery. So what we've ended up going through now for our final design, it's not going to be a 4-hour battery. It's going to be closer to a 5-hour battery overall. So that obviously improves economics for the project overall. And importantly, it doesn't actually increase the capital cost at all. It actually comes in slightly lower in the capital cost. With the battery as well, it's a 20-year degradation warranty that we get for the battery. So again, we're not looking to do this for a few years. This is long into the future.
How do these guys work this out? It's a fairly nascent industry and the technology is relatively new. So 15% drop off over 30 years. Clearly, batteries, they said solar panels haven't been around for 30 years. What's the diligence that you've done, or what's the evidence from you that you've discovered?
To be honest, we've spent a lot of time looking at a lot of different technologies and looking at all the different battery manufacturers as well. And again, we've only gone to the tier 1 manufacturers for all of the equipment we've selected. And again, they're the ones providing the warranty. If it doesn't actually meet those specifications, they're going to have to come out and replace it.
Okay, and the same with the batteries, obviously, whether it's 4 hours or 5 hours, if there's a warranty there, I guess in a meaningful way, you don't mind so much. Talk to me about the seasonality there, because I noticed in your presentation you talk about, okay, here's our January numbers, here's our July numbers in terms of price of electricity usage times, etc. Like that. How do you amortize that flow of energy and storage across the year?
Yeah, so our strategy is actually really quite simplistic. So in Western Australia, and WA is the sunniest place, especially Perth, in all of Australia. So we do get a lot of sun here. And that's the reason why household PV solar is one of the highest in the world. We're sitting at about 40% of households at the moment have PV solar on their roof, okay? When we look at the summer profile, the sun rises in Perth at about 5 a.m., okay? The strategy is going to be that we will sell energy into the market, so directly into the market, ignore the battery for a minute, from 5 a.m. till about 8, 9 o'clock in the morning. Once we get to about that 9 o'clock period in the morning, that's when PV solar starts coming through. So you can imagine at your house, typically in WA, the PV solar is always north facing. So that's where you're going to get the largest amount of sun come through. So as you get to 9 o'clock, the sun rises to that point, PV solar comes on, energy prices start to drop during that time. As energy prices drop, we switch the energy going off into the grid. We now charge the battery, okay? Say 4 to 5 hours later, the battery is now fully loaded. It is fully charged. It's ready to go. That's about 2 o'clock in the afternoon. 2 o'clock in the afternoon, the sun starts moving from the northerly direction across to the west. As it's moving towards the west, it's also when temperatures start to rise towards their maximum heat during the day. It's also when energy starts increasing again during that time. So from, say, 2 o'clock in the afternoon, we'll start selling that energy back into the market from direct solar. We get to 5 o'clock in the evening, PV solar's off, renewable starts slowly switching down at that point. We fully sell the battery. So over the next 4 to 5 hours, we fully sell the battery into the market. That 5 o'clock to 9 o'clock in the evening, that's known as the peak energy price period. So we'll fully sell that battery. We'll rinse, repeat, do exactly the same the next day. When we get to winter, different. Basically in winter, sun rises at about 7 o'clock in the morning. We won't sell any energy into the market until the battery's fully loaded. So generally, we'll find that it'll be the last hour of the day. There'll be a little bit of energy spill that will be sold into the market. Otherwise, we fully load the battery and then we sell that again into that peak energy price into the market from 5 till 9. Why do we do that? Because you can pretty much guarantee every day of the year, the energy price we're going to get at 6 p.m. at night is going to be better than any time during the middle of the day. There's always exceptions to the rules. We'll be flexible with it, but that in general, very generally is the strategy overall.
Right, and how do you set? We're moving towards a conversation around how do you get the debt and the equity into this to build this out. But before we get there, just understanding the kind of pricing mechanisms and how you work with the Western Australian government to kind of set that, because you obviously want to charge the most you possibly can, and they obviously perhaps with like a say in that, right? For you to kind of get the contracts. So what do those conversations look like as to when you're expected to kind of sell into the grid, whether it be directly or via the batteries?
Yeah, so just taking a small step to the side. So I mentioned it once or twice, this thing called reserve capacity. Okay, so I'll just step through that first because it is really quite an important aspect that underpins quite a bit of our strategy. So reserve capacity only exists in Western Australia. It doesn't exist on the NEM, the East Coast, only exists here. Basically, the idea behind it, and it's been going for a very long time here, is that to ensure that energy is going to be readily available for all users when it's most required in those peak demand periods. So the most peak demand period in Western Australia is going to be February when you have 40-degree temperatures. The government wants to ensure they've got enough energy readily available. So they've got this system, reserve capacity. So for every megawatt of firm energy you have available, you get paid an amount. That amount has been increasing over the last number of years. So last year, energy providers were paid $250,000 per unit of energy that had readily available. As I mentioned before, they've changed the technology. So it used to be a gas-powered peaking station was that benchmark technology. They changed it at the back end of last year to a 4-hour lithium-ion battery, okay? So when they changed that technology, we said, this now will help underpin our project going forward. So with the forecast that we've put in the DFS, we've assumed that potentially it will be $300,000 per megawatt for every firm unit of energy. So battery is a firm unit of energy. So 300,000 by 80 megawatts gives us $24 million of firm revenue that we get paid by AEMO and the government every year. If you have intermittent energy, which solar is, you get that at a discount. So we're assuming that will be about an 8% payment on that. So that's another $3 to $4 million on top. So from reserve capacity payments, we're going to be paid about $27 million per year, and we can lock that in for the first 5 years. The trade-off on that is we have a lower capped energy price in this state compared to the East Coast. So as of today, the maximum energy price is $738 per megawatt. That's changing at the start of next year to $1,500 per megawatt. On the East Coast, however, it's $16,600 per megawatt. So we get a lower energy price, but we get paid this reserve capacity price overall. Despite all that, we still have had the highest energy prices in the country over the last number of quarters.
Right. Okay. Let's kind of break down that revenue, because it's really important. I'm interested in not just as a percentage or dollar terms, but also the sustainability of that, and in terms of contractual obligation by WA government to you. You're indicating there that some of it can be locked in, but at your option, and or you may want to kind of play the market. I don't know, between hedging and running.
Yeah. So generally, what you'll find with most energy producers, they'll lock in a hedge. It's called a PPA in the energy industry. So that's where you go to a large industry consumer. They'll pay your price, and usually you give away the LGC or the carbon credit as part of that as well. Basically, we had discussions with a number of parties, and the discount that they were providing was way too significant in our opinion. So when we started off this process, we spoke to a number of the banks and said, well, in essence, we've in essence got a hedge in any case with this reserve capacity payment, because we can lock that in. Given that the reserve capacity payment underpins the interest, the coupon, as well as our operating costs, the banks we've been speaking to have said, you know what, you guys can play in the merchant market. So we sell that energy now directly into the market. So we'll be fully exposed to what the energy price is going to do. Because we believe it's unlikely to be coming down to historical lows to where it was before. We think it's likely, especially over the next number of years, as we continue the energy transition, to probably be going up.
Right. Okay. Let's look at this LGC, right? Because I think you're indicating it's about 16% of revenue. That's a big chunk, and in most companies that would be the entirety of their margin, right? So right now, nascent kind of sector with regards to kind of carbon credits globally, wherever you are, Europe, Canada, here, Australia. At some point, like we're seeing here in the UK with the wind guys, that's kind of dropping off and falling away, because governments are looking at new ways of not just taxing us, but also reducing outgoing spend. How do you envisage kind of protecting yourself in terms of future revenue? Will you be able to charge more for other components if that carbon credit goes away?
Yeah, so the LGC overall, I think if you look at the spot market today, so LGC, again, that's effectively a government-backed carbon credit. So the price over the last 3 years has probably averaged between about $45 to $60 per unit. In our study, however, we're being highly conservative, as we have been with all of our assumptions. We use a third party to provide all of those assumptions. I believe in the first year of operation, we have it at about $30 per unit. So that's in 2027. We then have it falling away to 2030 to about $15 per unit, and then falling away to $10 per unit from 2040 onwards. So we're being very conservative with those, with the carbon credit assumptions that we've got going through.
Right. But I think my point was, if that goes away completely, does this project stand up?
Yeah, listen, So in terms of if you actually have a look at the cash flow waterfall for this project overall at the moment, so based on the DFS, just to go into dollars and cents of it all, per megawatt of energy, the total revenue stack is about 30 cents per kilowatt hour. If we have a look at the operating costs for this project once we're up and going, so once these things are up and going, operating costs are extremely low. It's forecasted for us at about $6 million per annum. That works through at about 2.4 cents per kilowatt. So our margin overall is huge. Assume LGCs fall away to zero. We still have a large margin we have coming through from the reserve capacity, as well as energy sale prices.
Right, okay, because the debt guys are going to want to see, I guess, contracts in place so they know what's coming. I guess with regards to hedging or whatever, and whatever time frame that you agree. This is the first project, and it's also kind of, I guess, phase one for you in that sense. I'm sure you have ambitions to do more. You've got to get this over the line to kind of show a route to market. Not only can you build it, but you've got a profitable business which has decent margins. So, I guess in a meaningful way, are you kind of happy to kind of give away some of the upside just to get this thing over the line when it comes to the financing?
Listen, as I said before, so the financing process kicked off immediately after the release of the DFS. So that was call it the start of March. That went out to all the major Australian international banks and European, Australian, Asian, as well as European banks. From that process, we received then indicative offers from a number of those banks. We've been then working through with those banks over the last number of months through the ITE as well as that process overall. The key revenue assumption they're looking for is that reserve capacity.
Right.
As I said, Because we've got reserve capacity, we can lock in that price for the 5-year period. They're happy with that overall in terms of our revenue stack.
Right. So it's predicated primarily on reserve capacity, which you're indicating is about 36, so just over a third of your revenue potential. So the debt guys are happy just on that, or are there other things that you need to also deliver?
That's the key factor overall that they've been looking at. As I mentioned before, so if you look at our revenue overall, so the revenue forecast was about $74 million per year in year one of the operation. So we do have, I suppose, taking a step back, when you look, I'm not sure if all of your listeners are aware, so the terms you get for renewable energy projects on debt finance are probably second to none. So speaking generically, the terms are going to be, it's going to be over a 20-year term in terms of the amortization period. And the interest period payments that you're going to have, they're usually over the first 5 years range somewhere between about 2 to 3%. And after that initial 5-year period, they usually drop down to somewhere between at around that 2% interest coupon rate on top of BBSY, sorry. So the amount of repayment you have to make when you add up the coupon repayment, the interest component, as well as our operating costs, they're all covered by reserve capacity payments alone. As I mentioned before, the reserve capacity payment, that's looking at about $27 million per year over the first 5 years. Everything else after that is the cream on top.
Okay, the debt terms and the coupon on it is very encouraging and very helpful. So in terms of needing to think about refinancing this out anytime soon, I guess you don't need to worry about it too much. On the equity side, obviously looking at what 96 million bucks there with your market cap where it is today. I don't imagine that's going to be too much of a problem for you. But again, what do you think you're going to need to signal to the market to kind of get those investors on board?
At the same time as kicking off the debt financing process, we also kicked off a strategic process at the same time. I've got to be careful what I say here because we haven't announced a lot of it. But we appointed a group, Barrenjoey. They're a large Australian investment bank. The reason why we appointed them was because through the course of last year, we were reached out to by a large number of multinational groups, basically wanting to take a closer look at the potential of the project that we had. We decided that the timing was right now to basically run a strategic process as part of that and look to sell down part of the project. That process is going very well at the moment in a very advanced position. The idea would be, prior to FID, that we have obviously got the debt locked up and hopefully going to have the strategic process locked up as well to really minimize that equity gap to the lowest position that we possibly can.
Right, and you're indicating about 70% on the debt, right? So, what are the kind of alternatives that you've looked at rather than just pure debt in terms of forward selling some of that annuity stream of cash, assuming you sign a decent term contract with the WA government?
Listen, to be honest, when we talk about bringing a project partner, and it's not just looking for someone who's going to be coming through for stage one, it's going to be someone that we can hold hands with and really look to grow and accelerate this project really into the future as well. So expect from us, once we announce stage one FID, very, very quickly thereafter, stage two is going to be kicking off. The idea is that the market, as with any commodity, the market is there for us now. We really want to make the best of this as we can and really grow and accelerate this project as quickly as we can, because we believe the returns we're going to get at the moment are really going to be exceptional.
Well, yeah, given the operating costs are de minimis, really. Once the kind of capex is spent, the operating costs are around $6 million per annum. Is that right? Yeah, okay. That's what I mean about maybe forward selling some of that revenue. Just wondered if that was in terms of this being just a phase one and you want a partner who's going in for phase two.
Yeah, listen, not really. The only way you could really forward sell it is if you're going to lock in a PPA with someone. So basically giving away your future energy. If you're going to be doing that, as with any hedge, you're going to be getting it at a much lower price. With where we believe energy prices are going, I think we'd be selling our investors short to be doing that. As we said at the moment, we've got the debt facility, which is getting very close to being in place. We've indicated to the market before there's going to be around that $225 million mark. We believe with the support that we're getting, both hopefully through the strategic process, which is drawing to a conclusion, as well as equity market support, we'll be able to close that gap quite close.
Right, okay. And in terms of that, the scale of that ambition, this is stage one. Let's get the thing built before before we can run. What is the potential for this company in terms of just serving into the WA market, and have you also considered working outside of WA?
Yeah, listen, 100%. Listen, as you said, we want to walk before we can run. And I think through the process that we've been going through over the last number of years, especially the last 6 months, we've learned a hell of a lot. And I think we've got a real competitive advantage with what we're doing sort of at the moment as well. But as I mentioned, stage one's 120 megawatt solar with the 80 megawatt battery. We've got connection available for up to a gigawatt of energy. From organic growth that we'll be able to do at the moment, we can really grow with the strategy that we have. And listen, we'll always assess what is going to be the best alternative. So do we go for a larger battery? Do we go for larger solar? But we'll choose that right energy mix at that point in time. But I'd be expecting everything going to plan that we'll be coming through with a very similar strategy in terms of a study at the start of next year, followed by hopefully an additional FID on stage 2 at a similar time next year, to really look to grow this quite quickly thereafterwards. And then the year after, subsequently the same thing again. As other opportunities come out in the market, we'll obviously keep abreast of them. And if it's the right thing to do for our investors, we'll look to grow from there.
Right, okay. And I guess what I like about the story so far is the simplicity of it all. It is, you said you've been learning as you've been going along, and it is a fairly nascent industry and space for sure. But the simplicity of the technology and the operational component is attractive to me. What about competition? There will be others looking at this and going, hey, I think we can do this too. Given the simplicity of it, it might be very attractive to them. What are the barriers for them?
It's getting a connection onto the grid, to be honest. So I quite often say this in my hamlet. So we're located, and I probably should have pointed this out first. So we're located 100 kilometres from Perth, the major city in Western Australia, about a population of 2 million. And 50 kilometres away from where we are is Kiley. As I mentioned at the outset, that's been the major source of energy for Perth forever and a day. Still provides about 30% of energy today. When you look in and around where we're located at the moment, we're really quite fortunate. It's built in and around an industrial area. So there's a lot of energy coming off where we are. There's not a lot of other opportunities for industrial scale projects to come on, just basically because those grid connections aren't available where we are. If we look to the north of Perth, so from Perth up to Geraldton, which is about 500 kilometres north, fantastic renewable energy country. I would suggest some of the best in the world. The wind always blows, the sun always shines, and there's not a lot of other competing land uses up there. The grid, however, is full. If you can't get on the grid, you've got nothing. It's getting access to the grid, which is our major competitive advantage, and actually growing it in that right location as well. So it's that grid competitive advantage, working through the process with permits, environmentals, heritage, First Nation. If you haven't done that process, that's going to be a 4 to 5 year process. As you mentioned before, we seem to have got there quite quickly in terms of this final study, but the actual initial work on this project, it started in 2019. So whilst it seems like a bit of an overnight success, there's been a lot of work which has gone to get to this point in the timeline for the company. And now we've got there and we've done all those hard yards. Now we're really looking to accelerate it into the future as quickly as we possibly can.
Is this the slight aside, but is this the most efficient way to kind of get solar energy into the grid? Because it kind of feels like the domestic, homes, offices, industrial parks with solar on the, you've got sales costs, marketing costs, installation costs, maintenance costs. Is this a better way for Western Australia to kind of get solar energy into the grid?
Listen, I think a lot of industrial scale solar's maybe been scared off from Western Australia historically. And listen, you look at what PPA prices potentially you could have got only 2 years ago. You're probably talking sub $50, and that's including the carbon credit as well. It's a key reason why we're selling into the merchant market. So we sell into those higher prices as well as keep the green credit with it as well. In our belief, having solar, but having the battery included to ensure you can sell it in to maximize that price, that is the best strategy overall. Because rooftop solar, that's going to continue to come through. Rooftop solar, the excess solar, that comes through and that's going to be gobbled up by the large-scale batteries which have been developed. We believe having the solar generation to ensure we've always got that energy readily available for us to sell into the market when it's most in demand is the best strategy for us moving forward.
Okay.
And I'll be honest, we've looked at every iteration literally under the sun for different alternatives, whether it be solar, battery standalone. When we were looking at hydrogen, obviously in the past as well, we even looked at gas connections. This for us was the most simplistic solution, with the easiest way to actually get up and go in as well.
Right, and we mentioned coal earlier, right? So, and there's a lot of coal-fired power stations in Australia. People perhaps don't realise it because it seems very liberal, very eco-friendly Aussies, but there's a lot of coal power stations in Australia. But at the same time, the government of Australia has spent, it's reported, 29 billion Aussie dollars on wind and solar. So it's really kind of backed up the talk and the rhetoric. That said, there's also a lot of conversation now going on about nuclear's contribution in terms of renewables and nuclear replacing the kind of coal-fired power station component. Where do you sit in that argument?
Listen, I'll say I'm pro-nuclear. I'll say that from the outset. I'm pro a mix of all energies. So I think they all should be considered.
Except coal?
Listen, coal when you say coal is readily available across Australia, it is on the East Coast. It's probably the one commodity out of Western Australia we're probably a little bit short on. So when you look at coal, there's only one place really in WA, which is in that place, Kiley, where the coal-fired power stations are. We actually import coal from other parts of the world because it's running very low there. So it's a low-grade coal that they've got there. On saying that, we are moving towards decarbonisation. Coal is probably the main one that has to come off. It's the largest pollution overall. I personally think nuclear should be looked at. The problem, I think, for nuclear, again, only my opinion, is probably a little bit late to the party in terms of Australia. This conversation probably should have happened 5 to 10 years ago. As you know, in terms of...
they tried. I think they tried, Adam.
Yeah. And listen, and it's the evolution of energy as well, okay? So it's the electrification of everything at the same time. If we were having this conversation 5 years ago, demand has been relatively flat during that period of time. It's the way the increase in the amount of energy consumption that we're having, which has probably really driven this conversation a little bit more. But in my opinion, and again, it's from what governments have said as well, I think they're looking at about 2040 for that first lot of nuclear to potentially come on. That's a long time between now and then. So speaking again, only from a West Australian point of view, over the next decade, they're forecasting energy is going to increase by 55%. You can't just keep coal on during that period of time and then extend it even further into the future. So we're going to have to continue to build out grids, build out the renewable energy solutions. If nuclear is part of it in the long run, have a look at it, no problem. But I do think it's probably missed it a little bit in Australia. At the same time, you have a look at the conditions around the world and where nuclear works best. You probably argue that Australia is maybe the one country where we've got lots of sun, we've got lots of wind, we've got lots of spare land, which are the conditions you need for renewable energy. So again, I'm all for looking at every energy solution. I just think nuclear, in my opinion, may have been a little bit behind to actually get there.
Yeah, let's hope all of the above works, okay? Because I think the kind of key driver for situations like yours and any other energy provider has been, and you mentioned 80% in Western Australia increase in price. We've seen that across Europe, seen that in the US. It's reducing people's available capital, discretionary spend, all of those things which kind of hurt everyone in the wallet. I think that started a conversation with politicians to try and solve this, and I think renewables is part of that solution. I think nuclear is part of that solution as well for the everyday folk out there. Like, talk to me about the company and the structure. Like, can you talk? How does the share register break down in terms of institutional interest in this?
Yep. So if we look at the register at the moment, so the chairman, Grant Davies, got about 10% of the company. Myself, I've bought about 2% of the company, so just under 10 million shares at the moment. We've got good, probably at the junior end of institutional support at the moment. So we've probably got about 15 to 20% of that. Otherwise, it's a very tight, high net worth register overall at the moment. And listen, but we're growing that sort of all the time. I suppose that if you go back, well, why have maybe some of the larger institutions not gone onto the register as of yet? As you and your investors know, usually large institutions won't buy on market. They'll only enter a register when you actually do a capital raise. Since the company first listed, so I listed on the IPO, it raised $8 million at that point. It then did a $10 million raise there afterwards. That's been it. We've still got $10 million in the bank today. So we've really been watching the pennies on the way through, and there really hasn't been the opportunity for those guys to get in. But I take a lot of phone calls on a very regular basis at the same time.
Right. Okay. And talk to me also with regards to, like, so far it sounds like a sort of desk exercise. I come back to the simplicity of what you're suggesting here, and I accept that. But it feels like you're not burning through the cash. It feels like a desktop exercise in terms of how does this thing get built, who buy, and why you sort of guaranteed success in terms of delivering it on time, on budget.
Yeah, listen, as I said, we're inching very, very close now to actually getting credit approved debt financing terms. I'm gonna effectively in July now we'll have an announcement out through the course of the next month or so regarding how that's progressed. At the same time, we've got strategic partnership, which is really getting to that crux point at the moment, where we're going to be finalising that. Once we've got those two things in place, we're essentially, hopefully, going to be in that fully funded solution. It's going to be FID shortly thereafterwards, and then we continue on. After that point, it's a 2-year construct. We'll be generating energy as well as revenue in the second half of 2026.
Okay, but the question was, who builds it? How do you guarantee it's on time, on budget?
Yeah, apologies. So listen, through this process, we've also selected an EPC provider at the moment. We haven't announced it at the moment. That's going to be coming through to the market over the next bit.
Okay, fantastic. I like it. Nice. Okay, well, Adam, I appreciate you running through that, and sorry for the nature of some of the questions, but I think people looking at this want to get into the weeds and hear from you that it's all under control. You feel that this thing is going to happen. And it's happened quite quickly as well, which sometimes can be a problem, but I can come back to that simplicity. It's interesting.
Yeah, listen, we've moved really quite quickly to go from a definitive feasibility study released in February of this year to basically FID 2 quarters thereafterwards is quick. Let's not beat around the bush. It's very, very quick. But what we're doing is it's not different. It's not unique. It's basically a little bit of a plug and play. The panels that we're using have all been done before. The batteries we're using have all been done before. The connection works. There's other solar projects on the grid and cut. Nothing we're doing is special, different. It's all been done before. The difference is we're hitting the market at the absolute perfect ideal time. That's the key difference that we have, and looking to expand the project really quickly thereafter as well.
First mover advantage, a beautiful thing. Adam, appreciate your time today. Thank you.
Perfect. Thanks very much, Matt.